Welcome everyone to this Placer AI webinar, our apparel retail update. Thank you so much for joining us. A quick sense of what we're going to do, and then I'm going to introduce our guest. But I'm really thrilled that he is back, and it's been way too long, Simeon. But we're going to do a quick introduction to Placer data. We're going to show you kind of what is in the backdrop of this conversation. We are then going to take a brief retail outlook, kind of stop and look at what is happening at the moment in the wider retail landscape. And then we are going to dive deep into the apparel sector, into the sectors and brands that are thriving, maybe falling back, and ask some of the bigger questions for these spaces. And then, as always, we're going to set some time aside for a Q&A. If you have a question at any point throughout the conversation today, please hit the Q&A button situated either at the top or bottom of your screen, depending on how you have Zoom configured, and send it over, and we will attempt to answer as many as possible, either within the course of the conversation or at the end. So again,
and the Q&A can take song requests. For anyone that missed it, you can have taken karaoke song requests through the Q&A. Just the level set.
This is the after party. This is the webinar after party. I could not be more thrilled. One, because his insights and analysis are always brilliant, but two, because it's been far too long, my friend. Simeon Siegel, Managing Director and Senior Retail Analyst at BMO Capital Markets. Thank you so much for being here.
Great to be here. It has been a long time. I don't think either of us look like our pictures over there, but we'll take it.
I think sadly my reasons are not as good as yours, but all right, let's talk about the data you're going to be seeing in the backdrop today. So how do we get it? Placer observes a panel of over 30 million devices throughout the United States. Very critically, all of that data is anonymized aggregate data, so we are GDPR and CCPA compliant. We then analyze that data with machine learning and AI algorithms to make estimations on visits to any retail location throughout the United States. And we present that data in a wealth of different reports within our platform on everything from true trade areas, the customer journey, visit counts, void analysis, and a whole lot more. If you are interested in data like this, please visit our website, placer.ai. There is a section called The Square that has access to all of our free tools. There's also a free version of our premium product that you can access at placer.ai. And with that, we can dig into the really fun stuff. So I want to kind of start by taking a step back and looking at things more widely. And so, think the holidays, it was supply chain and it was labor concerns. In January, it was Omicron. Now it's gas prices and continued inflation. How challenging is this wider context for retail, and what does it mean for the sector?
So the beauty is, by the way, year-over-2-year changes is a beautiful, beautiful line. By the way, you got to flip that. It's now year over 3. So
I know.
The fascinating thing to me is you mentioned them. We've got Ukraine, we've got Omicron, we've got these things that probably for the better we could not have predicted. But then we also have, starting Jan 1 of 2022, we started lapping stimulus, pent-up demand, all this greatness that was the first half of the year last year. And so what's interesting to me, and you and I have had these conversations, there are certain things that can be predicted, there are certain things that cannot, and yet the things that can be predicted very rarely are. So there's this notion of the consumer, these 6 months should be a difficult 6-month compare. And we can look back 2 years, we can look back 3 years, we can look back to 2008 if we want to. It doesn't matter. People bought things last year, and the question is how many of them are they buying this year and what are they paying for them? So there was this phenomenal ability to spend and a phenomenal desire to spend last year. Both of those are getting harder. So where does that take us into the next 6 months? Well, I think the reality is, listen, you and I are not, I'll throw you in with this, like we're not smart enough to know how Ukraine plays out because unfortunately that's a lot bigger than we are and hopefully only for the best. But the things that we do know that we will be talking about getting further away from that initial stimulus injection. We know we'll be getting further away from simply leaving the home was exciting enough to spend. And so that's why I think as we look forward, I do think things aren't as bad as they seem. And then since you brought up inflation, I think there's an interesting dynamic here, which we're teasing out. And normally inflation starts at the cost and works its way to the price. It went backwards here. People all raised price 2 years ago, and now cost is catching back up. So there's these kind of sentiment factors that you bring up of thinking about price of gas at the pump and what that does to my disposable income psychologically and practically. But then there's also these macro factors where there are some external shocks that no one can predict that exist. But then there's also certain things where we know what we will be talking about 3 months from now. We just don't act on them yet.
That's really interesting. I want to touch on something that you brought up at the beginning with kind of calling out that year over 2 year. because this is something we're kind of grappling with ourselves currently, and I want to know your take. Year over 2 year is obviously not going to be as relevant now. If you look at March data, it's already thrown for a loop. The problem with year over 3 year is I, at least for me, I'm forgetting lots of context that would then help you understand why a certain week is up or down, and maybe not necessarily for the reasons that are fair to judge it on now. But at what point, I mean, so I guess there's two questions. How do you kind of look at things now when that year over 2 year is kind of going away? And at what point are you expecting to switch back over to year over year comparisons?
So it's such a great question. You and I are both in the business of using data. You have much better data. I have to pull things out of my head, but we both create models. And so all of my models had a 2-year run rate that all of a sudden, starting next week, flips to a 3-year run rate. So I look at that. Does it make sense? I have a huge problem with that, because at some point, we all want to believe that a company created a new base, right? Like, no one says, how did 2022 do against 2008 after the recession? It's just, that's not how we think, right? At some point you say, there's a new base and we need to look forward. I think the interesting dynamic is, the better the company, the more consistent the company, the more structurally sound the company, the quicker we should just go back to looking at comps, right? It used to be 1 year was a good trend, and you know what? Certain 1 years had storms that we had to deal with, and you just figured that out. I think that the more volatile companies, the ones that we watched die and then have this massive renaissance, right? Neither of which were true, but the ones that bounce back and forward probably need that context. So if you and I, we will get to it, so I don't mean to preempt it, but like, we think about some of the best quality companies, you know, I talk about in the off-price sector, I think at some point we need to be looking at these quality companies as simply, okay, last year was their new normal, and now we need to grow off of that. That's a 1-year compare. You look at some of the mall-based companies, some of the department store companies, and maybe we need more context. So it's not a great answer, but it's how I'm thinking about it, and it's how I grapple with it, because I'll go into certain meetings where people will tell me this company is just in for a world of pain because their 3-year gets really hard. And then another one will tell me, you know what, last year, pretty easy.
Yeah, it's interesting. I think our mentality at this point has been, we're kind of highlighting late April, May as when we're gonna make our change. But I think you make that a great point of, like, there's some segments that you do need that look longer back, because otherwise that rise up or that drop down is going to seem so massive. But it was just because there was something exaggerated during that kind of these last few years. But I want to kind of also talk a little bit about kind of the formats themselves, because this has been a really hot topic, especially within our world of, you know, looking at outlet centers, which obviously had a really unique advantage at certain points in the last few years, lifestyle centers versus indoor malls. Do you see a changing balance of power with them from a longer term perspective? You know, specifically for malls, what would be your expectation regarding kind of those top tier performers in the space?
So in the spirit of, again, returning to the fact that you actually use data and I have to kind of create things from my imagination, my latest view is that if you have 800 stores, you have too many. If you have 1,500 stores, you have too few. So it's just this idea of, like, we crave convenience, we don't crave e-commerce. So if you can tell me that in my mind, you're in my neighborhood, you're around, you're a 5-minute drive away, then give me more stores, because I'm going to come. If in my mind, you're a mall away, you're a 20-minute drive away, it's just a different mindset to get me up and out. So I think that, listen, again, I am never into the idea of saying platitudes, malls are dead, but I think what we definitely are seeing, listen, you're seeing some of the quality mall companies. Bath and Body Works gets on every earnings call right now and says that they're pivoting away. They're growing a ton of stores, but they're pivoting off mall. So I think holistically, this notion of the mall wasn't dead, but it's also not this massive return. But you just want to be, right? This is, I'm going to say something that is just so obvious, is no insight at all. You want to be close to your consumer if you're giving them a physical presence. You want to give them a reason to be there. So I think that will be a part of it. Open air versus indoor obviously is relevant in terms of where you live. You can't have a 2-month mall. But I think from that context, it does seem to say, despite retail coming back, I don't think all of a sudden the mall has this massive injection.
You know what? This is an interesting comment came in, and I'm going to touch on it just because I said something more about this recently. Convenience, no one likes to make left turns. I don't know if that's a famous phrase that I don't understand. So David, apologize if I'm not getting it. But I will say this. I think convenience, and you know, you mentioned this with the e-commerce perspective. I think it's very important, but I also think it's slightly overrated in the sense that why do we there are certain things we want convenience for. I want my gas station to be convenient. I want the supermarket that I go to run in for milk on the way to work, on the way home from work. I want that to be convenient. I'm not minimizing that in the slightest. But I also, I mean, I'm a suburban kid. I know the experience of driving 10 minutes extra to go to the good Target, or, you know, whatever that is in your context. So I do think there is this balance that certain experiences are really important, but I do think in some cases we overvalue convenience and we undervalue, or we don't properly contextualize convenience.
Yeah, listen, I think the last part is right. And by the way, the famous quote, I think the don't turn left, I think was this famous guy named Zoolander. But I think that at the end of the day, from what you're referring to, everything has to be contextualized, right? That's what we know. We know that everything needs its context, because you're not going to go to that extra Target to just buy cereal. You're going to go there for the experience that you're talking about, to find the new Ulta, whatever it's going to be. So if we start with the assumption that people prize convenience over e-com, right? People prize convenience. So the question then is, what's enough? What makes something special enough to be more convenient than my couch? There's nothing more convenient than not moving. So to even start the conversation of leaving, you have to put context into that equation. But I think it's this idea of what is it that people like versus what is it they're willing to give up. Experiential enough, obviously. But I think that's your point about, I wouldn't discount convenience. I would throw in context.
That's a great point. I think this idea of like relative convenience is super fascinating. I don't really know what it means in full, but it feels like it's one of those things that, ooh, there's something there, right? So now we get to dive in, and we're going to start with obviously the sector that everyone's in love with, department stores, right? And so I mean, I guess I'll ask this in the broadest sense, like what do you think about the current state of the department store and where the opportunity may lie?
I think that destination, and this is I think we're getting more comments in than we normally get this early. So this is great. We're either doing something really right or something really wrong. But I think it's this idea of destination and curation. And what was a department store originally? It was a place to find other things. So this idea of, at the end of the day, there are creators of product or IP, right? Someone creates a sweater or someone creates a poem, and it needs to be distributed to their consumer. So there's someone in the middle. You know, one of my huge crusades is to be anti-wholesale. This notion of going direct, that is, everyone get rid of the middleman. The middleman, especially if they're a department store, can be a very economical way to bring a sales force, especially in the real world. So I think that if done right, listen, we're staring at Macy's. I think Nordstrom has proven itself to be a very compelling partner to some of the latest, hottest digitally natives, right? Not digitally onlys, digitally natives. And so within that framework, there are brands that Macy's will work for as well. You need to just figure out your partnership. So this idea of department stores, therefore bad, extra fee from a middleman, therefore bad, I can tell you my team has done a lot of work on this. We did a 2-week report that turned into a 6-month report that we titled DTC is Not All It's Cracked Up to Be. And the conclusions, the cliff notes, were brands pivoting to direct, the largest brands pivoting to direct, did not see a relative increase in revenue, did not see a relative increase in gross margin rate, did not see a relative increase in EBIT rate, and did not see an increase in profit dollars. All those 4 things are mind-blowing, but they were fact, they were math. So I think within this framework, what it means is find the right partner. Don't just block them out.
It's a great point. I also feel like we forget like the neighborhood goods, granted small sample size example of, there is this place for exciting, new, cool department store that, you know, whether it be Nordstrom's, whoever, there is this place to move and evolve too, that's really exciting. I want to, all right, we are getting great questions today, guys. Keep them coming. We're going to have to cut this off soon so we can get to those. I want to talk about, just, you called it out before. So before we start taking some of the questions, off-price has been this kind of incredible performer throughout. I think it was doing well pre-pandemic. It's likely going to do well post-pandemic. I think there's value. There's this unique experience. There are visits. There are sales. What's the next step for this sector?
And by the way, so here's going to be this, you have the year over 2 years, look at the year over year, you look like, this is going to be interesting because, so I think what's happening so much, and I'm really excited to watch where the chat goes from what I'm about to say. So much of retail is demand driven, right? You're talking about, do people have the desire and the capacity to spend? I think right now off price is in this wheelhouse where a lot of it is supply driven. Do they have the product? And there's a lot of conversations around there about inventories finally starting to get higher. And the reason is we can see inventories on the balance sheets are higher. What I think people need to internalize is the fact that those are dollars. So there's in transit, which is a pull forward. Retailers don't actually have that. But on top of that, it's also dollars versus units. If inflation is costing my product more, then the dollars we see are not as reflective of the units actually on the balance sheet. And so what I mean by that is, are there red sweaters that didn't make it on time for December that are going to be marked down? Sure, there's probably 5 of them. So there will be promotions. I just think right now we're not in this massive inventory onslaught that I think the perception may be. I think that will come. I think that at the end of the day, we will see TJ and Ross and Burlington and anyone else in this sector find a lot of product come their way, but that's later in the year. And so I think as you look at this, and I haven't closely analyzed, and again, we would want to put context here, but it's not that surprising to see that all of a sudden right now off price, because the inventory is a little clean and they're a supply driven environment, that we need to see where they go from here. Longer term, it's hard to argue that this sector is not an ongoing share taker. Longer term, my thesis would be, if direct needs to remove product from the channel, from the department store channel, they probably need to put it in off price. That's a heated comment I just threw out, by the way.
Yeah, I like it. I mean, what's your take on, apropos the last slide, this, we heard that backstage is going to be a bigger piece, talking about Nordstrom Rack potentially being a bigger piece. How do you view these kind of more premium retailers having their off-price arm?
So Abercrombie and Fitch had a full price store, and then it had an outlet. Mm-hmm. The outlet originally was meant for clearance, then it became its own channel. You make a made for product, which is actually better margin, take quality out, then it reverted back. And again, it's not just Abercrombie and Fitch, it's all brands. If your off-price derivative is an outlet, then you can call it off-price all you want. It's not an off-pricer. If it's a separate business with a buying team that buys the way off-price buys, knowing that they're able to pick up what people need to get rid of, then sure, right? Then it can be. The hard part is when you have a core business that creates its own clearance mechanism, it's hard to remember to keep them isolated. And one thing that I will say, and you and I have talked, I think this is a very strong view of mine. I believe TJX wins because it does not have e-com, not in spite of not having e-com. And it's got like a point or 2 points. It's got a tiny e-com, but it is invisible. The brands know they can dump product and no one will know. Nordstrom Rack has, I believe, a quarter of its business done online. So you have to ask how much of the proposition that it's offering, do you just serve your customer and give them a great value? That's great. But I think where off price is really going is they serve the brands. They become a place for these guys to drive a lot of units in an invisible, less brand eroding way. You can get paid less from TJX and still be less brand eroding than give product to a department store if it's constantly being blasted out online as a friends and family discount.
It's very interesting. This is something we had Billy Taubman, the president and CEO of Taubman Malls, on recently, and he was saying something very similar, which is how significant that upper tier of luxury within the apparel space is, and the benefits that they've seen, whereas those who allow that luxury brand to be eroded have seen an even more significant decline of late. I almost feel like I should just say digitally native brands go, but there's more companies entering the mix. More of them are recognizing that there is a value of the store, whether it's through a partner or through a wholesale channel or kind of their own stores. I mean, considering your take that a lot of these folks are not necessarily, shouldn't be, let's say, owning the full retail experience, what's the long-term potential of owned retail from these digitally native brands?
So listen, our mutual friend Steve likes to call them analog native. I like to call them digital, like not digitally only. Like, it's the descriptor, and figuring out how many different letters to throw into one acronym is a lot of fun. But at the end of the day, what they're finding is if they want to become big, like, listen, here's the fun thing, right? You mentioned that you guys are compliant with all the new rules. That's really important because a lot of companies are not. And a lot of the brands use that to get to people. You know who's never complained about changes of iOS or changes of IDFA or anything like this? The largest brands in the world. You know who's never complained about not having 1P data, right? We all want 1P data. We want to go direct because we want to be able to know everything about our customer. The companies that know everything about their customer sell hundreds of millions of dollars. The companies that know nothing about their customer, and I'm being hyperbolic, but the companies that sell to department stores that don't have that 1P data have revenues in the billions of dollars. So I'm not saying don't have 1P data. I'd rather have 1P data, but the value that it ascribes does not seem to counter the value of having a competent Salesforce distribution channel through the Nordstroms of the world. So what we're finding is that the digitally startups, right, the digitally natives are now working their way into stores. That's already known. So we have seen, right, you've got Warby and Allbirds here with their store counts. We're going to continue to see that. I mean, to scale, e-com is a variable intensive business. Stores are fixed costs. You scale that, you make more money. But what we're also starting to see is these brands, some of these brands, and some that are not on here but would fit, start embracing wholesale more. That, I think, is this duality. What I love is omni-channel as a term pre-pandemic meant embrace e-commerce. Omni-channel post-pandemic meant only embrace e-commerce. Like omni still means a bunch, all. So that's where I think is like, again, and I want to stress, I'm not anti-direct. I'm anti-wholesale. And so what we're seeing here on your screen, I think will continue to go. And I think we'll see it across the board because at the end of the day, the largest companies in the world, the most profitable companies in the world, recognize that they have to do a lot of things and be willing to give up certain parts of their business to other people.
Yeah, I have to tell you, one of the really interesting things we've also been hearing quite a bit, and I had a call with someone about this yesterday who I promise to, if he is listening today, I promise to give him full credit when we take this project through to its kind of finality. He was talking about the idea of how much brands are looking at their store footprint, especially their direct-to-consumer store footprint, as marketing dollars, as how do I get my name out there? The amount I'm spending online is to get these really low conversion rates are such a challenge. And so it's obviously it's not all stores and it's a place you still want to sell from. There's no question that's a big piece of the puzzle, but there are these other values that are becoming more and more significant in the way they're viewing these expansions. And I wonder how we get to that point of finding ways to express that value from a data perspective.
So I don't know if you remember it. It was one of our first conversations. Our moments mean more to me than you sometimes. But one of our very first conversations was that the way I like to think rent and marketing are the same line item. Right? The store used to be, you didn't have to be a money-losing flagship to be a marketing tool. The windows were your marketing tool. You bring someone through the lease line. That's the point. So I used to think about them, or I do think about them generally in the same context. The difference is rent scales, rent leverages, rent you pay once, and the dollars flow through gravy. Obviously, there's incentive rent and contingent rent, but generally speaking, base rent, you make more money the more you sell. Marketing dollars fluctuate and flex with revenues. So 100%. I mean, if you can find the right place to be, there's nothing more powerful than walking by a storefront and being brought in, and you don't need an iPhone tracker to do it. But at the end of the day, you do, the whole point was, without that, with marketing dollars, with e-com, I'm able to reach more people without laying down the fixed cost. So that goes back to this whole conversation. And what I'll tell you, what's funny to me is 10 years ago, we all knew e-commerce was going to be higher margin business. Why? It was obvious. There's no stores, there's no rent, there's no labor, all those things. Took about 5 years for people to realize that was obviously incorrect. I'm starting to hear in my conversations, people slipping back into thinking that e-com is actually more profitable again. And I'm trying to figure out, like, I go back, I'm like, why? And then we find we're back circular logic and we're reverting 10 years ago. So it's this really interesting thing that I think keep in mind, because it's starting.
Oh, it's a good one. I want to get to this question. There's a bunch of really good ones, and I'm going to go through them quickly, and then we'll get back to the flow of our own conversation. Brian said, based on all of this data and research, or in this case, all of your data and research, Simeon, where do you see the biggest opportunities ahead for brands in the retail sector?
Yes, I mean, where do I see the biggest opportunity? I think that, listen, I think the beauty here is we all want to be innovative, but I think the oldest way was the best way. I think find a good partner. The knock on department stores is that they have low gross margins. Low gross margin simply means high COGS. High COGS simply mean the vendors don't pay a lot. Low gross margins means you're a very economical, inexpensive sales force. So doesn't mean blow it out. Find the right partners and embrace it. So that's the way that's where we think, right? I mean, I think that the reality is have a certain chunk of your business that's direct, have a certain chunk of your business that's wholesale, figuring out where the blend is. And it's an unhelpful comment at large. And my whole point is you want to be nuanced. You don't want to be fanatic. You want to figure out where you fit within that spectrum. But what I'm trying to do is don't issue wholesale at the top. The biggest brands don't think that going direct is going to be this huge margin unlock. And if you're just starting off, definitely don't ignore it.
And then I'm going to do this one and we'll get back into the flow of it. Sheldon says, and I'm not going to read the whole question. It is a longer one. And I'm going to be really unfair. So Sheldon, I apologize. But I'm going to give you just the end. Department stores are the walking dead. And with a few exceptions, will all be gone in a few years. about 700 exclamation points. Simeon, true or false?
False. And Sheldon, I'm sure the spirit of what you are saying,
I didn't do you
absolutely
justice,
get and
Sheldon.
agree. We agree, and there's more comments in there. But simply true or false, I do not. There will be department stores go forward, and the question honestly will become, what does a department store look like? And what we're seeing that, listen, even have, I think Ethan's point historically has been Target is a department store, or Kohl's is an off-pricer, or figuring out how amorphous to make the theme. But boring department stores for no reason to being will go the same way that boring luxury stores will go out of existence as well. So I just think that the big platitude, I think, is dangerous. A box that gives me what I want to get, whether that's called Walmart, a grocery store, or a department store, will always exist. The question is in what capacity.
I could not agree with that more. We'll do this quickly, and darn it, the questions that are coming in are fantastic. Please keep them coming. So I want to look at the beauty sector just a little bit, because I think it's been really, really exciting, and it feels like there is this space that's been almost perfectly aligned with where the world has gone. And it feels like it's really well aligned with where it's going. And there's been some really great strategic decisions that seem to only take the sector to new heights. How big can 2022 be for the wider beauty space? And what do you think could throw that off?
Yeah, so we've got some really exciting things happening in beauty. I mean, you're showing the two transformative specialty, and you're not overlaying them on where they're going to our discounter, department store, et cetera, right? Both of these are entering the other markets. Mm-hmm. Which is interesting, because if you think about it, what that's arguing is they're turning their own specialty store that sells third-party goods into a brand in and of itself, which is not unheard of, but is a imaginative approach, right? I mean, Ulta and Sephora are the boxes. They carry other people's brands. Now they're turning their own box into a brand, and that's enhancing this idea of what a department store can become. Beauty as a category is interesting, because beauty went through a really fascinating over the pandemic. At first, there was no reason to do anything cosmetic-wise, and skincare was great. Then you realize, you know what, we're all sitting in front of here, and maybe I don't like it, right? I got to touch up some things. I think that beauty will always be a good category. The question is where, how, and where, and who. And so part of this conversation, which I'm going to drop in and then walk away because it'll take too long, will be, what does this mean from a VC perspective? Because so much of beauty innovation starts from the startup, right? And as much as we want to believe apparel is wildly innovative at the startup level, there are certain companies do it, but beauty is always innovative. So some of those dollars, which is the capital market side, will be an interesting conversation, but I will keep it a little bit broader here and say that beauty is, until they stop innovating and until people stop caring about health, wellness, how they appear, et cetera, the ones who capitalize well on this from an experiential state, from a store state, from an e-com state, all of these things, I think have legs.
It's a really interesting one. I want to get to a really great question that came in, and it was, we see the desire for major brands to be folded back into main streets regionally. Is this a national trend as well? From Christina. Your thoughts?
I'm trying to read it as you say it, and I'm trying to find which one you do. By the way, we've never seen this. This is like, I know, right? Blowing us up here. This is great. So what? So okay, give me the question again. I'm going to look at you.
We see the desire for major brands to be folded back into main streets regionally. Is this a national trend as well?
It's interesting. I think that if we think about what we just looked at with your digitally natives, it's still regional to national, not national to regional. But I think that every national brand wants everyone to believe that they are appealing directly. Personalization is obviously a theme that everyone wants, and that various forms of tech allow the largest brands to make you feel. So I think that I very much agree with that on a philosophical level. Do I think practically speaking, companies really pivot, or do they just convince people that they've become more localized and they go along that route? I'm probably more inclined to think the latter, but I also am on Wall Street. I'm supposed to be a natural cynic, so that would have to be the answer.
So I'll be the optimist to your cynic. Christina, I say yes. I think there is you see it with things like Bloomies, these new formats for lots of big retailers trying to hit that high street, that kind of main street location, as opposed to just being in those major centers. I think it's something we're going to see a continuation of. I think the really interesting thing will be to watch major cities that saw a transition out of some of its older, 30s, early 40s people moving out into the suburbs, and an influx of people who are potentially younger coming into the mix. Does that create more of a pull for flagship style stores in some of these major urban areas? it's gonna be a really exciting trend to watch. And I think it could create some really exciting movement within the retail space. But now we get to go into a sector.
You had that answer. You had that answer too prepped. I think you planted that question. You were like waiting.
I have
that.
loved, this is one of my favorite topics. So that's why I definitely went to it. But now we get to go to an area that you know better than anyone, which is athleisure. I made the mistake once of thinking Lululemon was overextending itself in major cities. And I realized that you can never ever go against Lululemon ever. It's just a mistake. And it seems like this space is kind of going to continue into this ongoing trend of massive success. Is that what you're expecting for athleisure more widely?
All I know is you just officially, in front of everyone here, the 3,000 participants, I just gave away your numbers, your viewership, I apologize, but you just threw in the towel. Your last data point shows you to finally be right. Right? If I'm looking at top right over here, I've got some negatives.
Yeah, it's short. It's
just saying.
February.
Just saying. Block it out. Rewind.
I'm taking the L. I'm taking the loss.
At the end of the day, I'm going to agree with Christina and say you can only be so large, right? You have to stay personalized. I think there is an element, you and I have talked about this, where brands peak at a certain level. Another report that my team had focused on, we found that DTC, and I mean DTC versus wholesale, not digital versus e-com, or digital versus stores. So DTC businesses peak at around 3 billion in North America. Wholesale goes a little higher, goes 5 to 6. Companies then come back. There's a ubiquity point. And so at the end of the day, what we are finding, what that means in real people terms, is that you see the rise of Rhone and Viore and Alo and beyond. Like, there are other companies entering here. So athleisure as a group, I am a firm believer that whether you're working from home or going back to work, comfort is here, right? I don't think everyone thought we were roaring 20s. We're already in March of 22, and I haven't seen a single person wearing a tux with coattails to the office yet. So within that framework, the category will have to keep growing. The question of the mix and who's going to play, and do the big players join in and create their own versions of an Athleta, that will happen too. So everyone's going to do it. But I think athleisure it's just hard to argue why someone would give that comfort back once they were given permission to take it on.
I agree with you. But now we get to go to, I call this space out. And if I like patting myself on the back as much as the next guy. But if there is one that I felt like a conversation you and I were having 2 years ago, it was this one. And it was talking about, in the midst of Peloton is the greatest thing ever, goodbye gyms forever, shut them down, and just, say goodbye to the space as an entirety. We've seen that kind of pendulum swing all the way back, where it does feel like there's been this kind of, acceptance of reality that Peloton is an amazing product and it's really got something valuable to bring to the market, but it is part of a wider fitness whole. And that means that the average chain still has a pretty strong opportunity as well. I wonder, from someone who really got this space right a long time ago, when everyone was kind of zigging, you zagged, what does the future of offline fitness look like from your perspective?
I love how it's at the end, because it's, or somewhere towards the end, because it's such an easy answer, which is a horrible thing. It looks exactly like what we just talked about for the last over many slides. The future of fitness is omni. Omni doesn't mean one, omni means many. So at the end of the day, people like convenience, but if you put context in that, they will leave for something special. People love the gym. Certain people are going to love to work out with something on their wall. And so listen, there's a natural price dichotomy here, where Peloton wasn't naturally going to be the Planet Fitness customer, but you can also get free weights. There's ways to do things. At the end of the day, Peloton did something truly special. Peloton helped open up a market that had existed for decades, but really catalyzed and got other brands to embrace the innovation. But we're seeing the return to gyms. People want to get out. This is part of what they do. And so it goes back to this idea of omni-channel and context. Those are probably the two big takeaway words here. And so does that mean all gyms will succeed? I don't, the question about department stores already being dead, but there are plenty of gyms that are already dead. And the same thing, if all you offered was a location, there is no location better than my house. If what you offer me is an experience, then I'll get up off the couch. And I think that's going to be part of this conversation. And it sounds overly simplistic, but I really do think we watched this story. 15 years ago, everyone thought e-com was going to come and destroy all of retail. And we know that not to be true. It's complementary. It's part of it.
I couldn't agree with you. One of the things that was really fascinating was we were at an event in December, and we were hearing from folks within this space about how much of an uptick they're seeing in people who are doing all of the above. They do CrossFit and Soul Cycle and Planet Fitness, or they do Peloton and Planet Fitness and some other class that they love. And this combination is people putting their kind of a la carte menu of these. You don't have to choose one. It would be like saying, do you want Netflix or Disney Plus? Some people want both. I want to get to a question.
The more it becomes digital.
Go ahead.
Go for it. I was going to say, yeah, you're right. The more it becomes digital, the more you can go a la carte, or you can have different subscriptions here and there. But sorry, go.
No, absolutely. And then I want to get to David's question. David asked, can you please comment on how the phasing out of work from home will impact apparel retail sales?
So that touches on, and then I'm sure since Ethan picked the question, he's got a strong view on it. So I'll go at your answer. But I think we touched on it a little bit, and I don't think my opinion should carry all that much weight here, but I don't think people are going back to wearing suits. Like, I think the new business casual, I went to an event last night and most people are wearing a blazer and jeans. And so I think that comfort is here, a little bit more casual is here. I don't think we got that rubber band bounce back to, I want to be really formal. But obviously, if you are going, you're not going to be wearing just sweatpants. So it could create another closet event. I mean, we're seeing, and by the way, for anyone listening, I am not the one who should be opining on fashion trends. There's a lot of people a lot better than I am there, but we are seeing the removal of skinny jeans. So there is now a new denim trend. Every time there's a new denim trend, that triggers a need to either find the stuff from your closet 20 years ago or go out and rebuy it. So I think that there is a good catalyst for apparel anytime there's a catalyst for newness. But I do think I just not in the boat where all of a sudden everyone's going back to business formal in any capacity, or rather in any normal capacity. They'll have them for events. And I think you still want to be somewhere around comfort, technical, et cetera. The question is, can you embrace those two? Can you create what Lulu did really well with the ABC that has now been worked upon? Many others have different iterations of that. But tell me if you disagree.
Your answer is excellent. I feel like that we've set a new high watermark of I've never in our wonderful conversations, as insightful as they've been over the years, I got a new denim trend from you. That's a
well, I was about to say the problem here is you're the one wearing a button down. I'm the one wearing like whatever comfortable t-shirt I'm wearing. So like you've watched if we look at the de-evolution of my
It's true. It's a case study. Another question came in from, sadly, anonymous attendee, but we'll go with it. Can you elaborate on why e-commerce isn't as profitable and where the misconception of e-commerce being profitable comes from?
Yeah, it's a great one, and it's a long one. I'm going to try. I don't know who you are, anonymous, but feel free to reach out to me and I can try and go into more depth. But I think effectively why the perception is, if you don't have rent and you don't have labor, it would seem like you obviously are going to have better profits. What we found was that may be true in a vacuum, but all those costs are variable. So you pick, pack, ship, fulfill, return, reverse logistics, incremental marketing spend. All these things effectively are a unit economic basis. So no matter how many of them you sell, you're still paying that number. Whereas once you pay your base rent for your stores, you start scaling, right? So if I go on vacation, I'm still paying my mortgage. Now I just add a hotel to the expense structure. So it's this incremental variable. That's probably the most simplistic way. And for certain companies, that's oversimplifying and it'll be wrong. So again, I want to stress there's nuance there, but that's the highest level. From the wholesale versus the DTC components, that's digital versus stores. For the wholesale versus DTC component, naturally you'd imagine the gross margin should be higher. If I make a sweater and sell it at a department store or sell it on my own website, it's the same cost of good, double the revs, and it's not actually double, but generally speaking, an easy dumb number to throw out. So the gross margin should be better. But then if you're selling via your own store, it comes with that same rent and labor, et cetera. And if you don't have that, the same e-com conversation. So generally the gross margin is higher. The operating expenses end up dwarfing that. It's much easier to ignore OpEx because we're trained to think about brand health, and gross margin equals brand health. What increasingly I'm trying to stress is gross margin equals brand health if it's because of markup and promotions, not if it's channel. If it's channel and region, that's another operating structure conversation. It just happens to show up in the gross margin. Nuance, but happy to elaborate if there's a way.
No, I think it's important. I also feel like there's all these, coming from, I did not start analyzing retail. I came from kind of the startup ecosystem. And one of the big questions you see so many startups trying to answer is dealing with returns and sizing online because of the costs that go along with how expensive those returns can be, what they mean for the brands that are dealing with them as they tend to have this bigger emphasis on e-commerce. So there are other elements that the stores bring to the table even beyond those. I want to get to a question that just came in. How do you see inflation impacting the different discretionary sectors, apparel, department, beauty, et cetera? Is it a blanket effect on the industry or more nuanced?
Because that's way above my pay grade, way above my intelligence pay grade. The easy answer is it will be nuanced, and it will be by product, like levels of discretionary. It will be based on demographic, like in terms of who level of income. But then what I think is also really important is it's going to be based on company specific price elasticity of demand. The way that I've tried to think about companies, winners and losers over the last 2 years, rising tides have lifted all boats, receding tides pulled them all back to sea. But now 2022 is the year of divergence, in my opinion. And what I've tried to isolate are the brands that improved, the companies that structurally improved pricing power versus the ones that just saw higher prices on inventory scarcity. Inventory scarcity will go away. Promotions will come back. If you didn't structurally improve your pricing power, if you didn't improve your price elasticity of demand, bear hug your brand loyalists, let those dilutive price sensitive shoppers go away. If you didn't do that, the discounts come back, the price sensitive shoppers leave. The inflation will hurt more over there. So that's both the cost input, because you won't be able to pass any of the price through, right? The easiest way, the best way to pass inflation is through price. If you don't have that lever anymore because you already went to that well, but didn't do it structurally, you just did it because there were no promotions across, I think you're going to be more in trouble. So again, not that helpful in the aggregate, but I think obviously income demographic, product discretionary versus staple, but then even within that, I would look much more bottoms up and figure out, is the company healthier or not? I think a lot of companies are walking out of the pandemic healthier than they walked in if they chose to make the right changes.
I also think it speaks to, in a much softer sense, it speaks to how much you've been investing in your brand, in your relationship with your core audience. Do those people kind of part of this, direct to consumer move, and this, or that we've seen so much of from the Nikes of the world, Adidas, Puma, Lululemon probably also fits within that, is that focus on enhancing that relationship so that core audience is there to spend the money on specific types of products. I think, as we kind of run, I feel like we've spoken a lot about Omni. So I want to skip to kind of the last one. I want one brand that you think will surprise in 2022.
So listen, I'm just going to use the line of thought that we just had. I think Under Armour, which we didn't bring up really athletic other than athleisure. I think Under Armour did a nice job of improving their brand. I think Under Armour did a nice job. I think Under Armour was a classic example of too far, too fast. Put a logo on anything and watch it go, and they diluted their brand. And they used the last 2 years to improve the gross margin, the health of the brand equity. At the same time, their operating structure is much healthier. So I think like they are well situated, both with they have the license to return to brand equity. Once a brand achieves that, it's really hard to destroy. It's not hard to erode, it's hard to destroy. And I think they had the presence of mind to start making those changes. So that's one that I'm excited. I mean, there's a few of them, but that's, you asked for one. That's one that I'm excited about that I think checks a lot of the boxes we've addressed in this conversation.
That's a really good one. It's the sports brands it's so fascinating how often you can I know this is like a silly indicating metric, but like, who are the athletes they're working with? That move was, Steph and Curry just 2 years ago, this kind of reinvestment back in that space where they had lost their way a little bit. I think was a really fascinating thing where the marketing, the business structure, and some of these challenges were all aligning to create something bigger. And then my last question for you, ask for a brand that you think is going to surprise in 22. I want one specific.
I'm not answering the next one. If you give me a bad one, I'm not answering. I'm just telling you. You decide if you want to ask the question.
One segment.
So what was the question?
I want a segment that you're very excited about and why you're excited.
I mean, the easy one is athleisure. So I'm going to take a second and think if there's a different one, because we just talked about, listen, athleisure and off price are the boring but right ones, because these are the ones that can move that direction. Oh, I'm going to give you one. I'm going to give you one that's going to be shocking, given everything you know about me and Peloton. I think connected fitness is going to have a special year. I think that as an industry, right, everyone thinks about me as like, oh, Peloton, the world's imploding. I like my Peloton for what it's worth, but I also like my Tonal and Hydra. Like all these other things, there's just a lot of innovation hitting this category. And I think without hurting gyms, I think that the reality is this is a sector that I think is still in its infancy and is dollars behind it and is starting to kind of hit certain tipping points of brand awareness. So how about those three?
That's a great one.
Off price, connected fitness.
I feel like there's going to be an I think I like that one a lot, because I think there's going to be an acquisition this year. I think one of these big, you see, like Lulu actually did make some acquisitions, but like Peloton made some interesting purchases. But I think you're going to see one of these fitness players take a hard push into connected. I think that would be, if I was being especially bold, that's what I would say. And with that, I want to, Simeon, thank you so much for joining. This is always a pleasure, but it was especially sweet today because of how long it's been. Thank you so much for joining, and it was great having you. Everyone, thank you so much for being here. We hope you all have a wonderful rest of the week. Our next webinar is mid-April, and we look forward to seeing you then. Simeon, thanks again. Everyone, thank you for being here, and I hope everyone has a wonderful rest of their day.